Silver hit $120 an ounce in January of this year. Then, in a single week, it collapsed back to $67. The mainstream media called it a crash, a bubble popping, retail traders getting wrecked. But here's what nobody told you. While COMEX prices were falling, physical silver in Shanghai was still trading at the equivalent of $90 to $130 an ounce. Let that sink in. The price on your screen said one thing. The price the biggest buyers in the world were actually paying said something completely different. That gap, that massive, persistent disconnect between East and West, isn't noise. It's not a glitch, it's the signal. And in this video, I'm going to show you exactly what that signal means, who's behind it, why it's tied to the biggest monetary shift since Bretton Woods, and what it could mean for silver prices in the next 12 months. Stick around, because the last section, where I walk you through the actual price scenarios, is the part most analysts don't want to touch. Don't skip it. Before we dive in, nothing in this video is personal financial advice. I'm here to break down what's happening, what analysts are saying, and what tools you have available. Always do your own research and speak with a qualified advisor before making any investment decisions. Wait, what even happened to silver this year? Before we get into the big picture, let me quickly catch you up, because if you're new here, the silver story of 2025 and 2026 is absolutely wild. Late 2025, silver had been quietly building pressure for years. Industrial demand was growing. We're talking solar panels, electric vehicles, AI data centers, all of them consume massive amounts of silver. At the same time, mines weren't producing enough to keep up. The market was in a supply deficit for the 5th straight year. Then, in November and December of 2025, investment money started piling in. Not just retail, institutions, funds, sovereign wealth. Silver crossed $80, then $90, then $100 for the first time in history. And in January 2026, it touched $120 an ounce, a new all-time high. Then came the crash, mid-March 2026, one of the ugliest weeks silver has seen in decades. The CME, which runs COMEX, the main U.S. silver futures exchange, raised margin requirements. That forced leveraged traders to either put up more cash or sell. Most sold, fast. In a matter of days, silver dropped 40% from its peak. And right now, as of late March 2026, it's grinding sideways between roughly $67 and $73, what traders call the chop zone. This looks like a dead market on the surface, but underneath, something very different is happening. I want to ask you something before we go further, and I genuinely want to hear your answer in the comments. Do you think the silver crash was manipulation or just normal market mechanics? Drop a 1 or 2 below. 1 for manipulation, 2 for natural market. Let's see what this community actually thinks. Now, let's keep going. The East-West price split and what it's actually telling you. Now, here's where the story gets really interesting. While COMEX silver in New York was crashing, or at best grinding sideways, silver on the Shanghai Futures Exchange, the SHFE, was trading at a $14 to $26 premium above Western prices. Think about what that means in practical terms. If you could buy silver at $68 in New York and sell it in Shanghai for the equivalent of $82 to $94, you'd do it all day long, right? And traders did try. But here's the problem. Physical silver kept flowing east, and the premium didn't close. It persisted. That tells you this isn't arbitrage that the market will fix naturally. This is structural demand that the Western paper market can't satisfy. Let's look at the numbers. China imported over 790 tons of silver in just January and February of 2026. That is an 8-year high. They aren't buying this for jewelry. They aren't buying it to make cutlery. They are stockpiling physical metal in a way that mirrors how central banks stockpile gold, and very few Western analysts are connecting the dots on why. Meanwhile, SHFE vault inventories, The warehouses that back those futures contracts in Shanghai are sitting near decade lows. The shelves are being emptied. And on COMEX, similar story. Vault outflows of hundreds of thousands of ounces. Backwardation in some contracts, which is finance speak for people are paying a premium to get the physical metal now, rather than later. That only happens when supply is genuinely tight. We're about to get into the part most financial channels won't touch, the geopolitical engine behind all of this. It connects everything I just showed you to the biggest monetary story of our lifetime. If you've never heard of the BRICS unit, stay right here. This is important. The petrodollar is quietly dying, and silver is the replacement layer. Let me give you a very quick history lesson. I promise it's relevant. Since 1971, the global economy has run on what's called the petrodollar system. The basics are simple. Oil, the lifeblood of every economy, is priced and sold in US dollars. That means every country on Earth that needs oil also needs dollars. That creates permanent global demand for the US dollar. That system has given the United States enormous financial power for over 50 years. Saudi Arabia has been signing deals to sell oil in Chinese yuan. Russia is now pricing a significant portion of its commodity exports in rubles and yuan. India, the world's third largest oil importer, is actively developing payment systems that bypass the dollar entirely. And in 2025, the BRICS nations, Brazil, Russia, India, China, South Africa, plus a growing list of new members, formally began developing what they call the unit, a proposed settlement currency backed 40% by gold and 60% by a basket of BRICS currencies. Now, every financial commentator focuses on the gold part. Gold is the BRICS reserve asset. That's the headline you see everywhere. But here's what they're missing, and this is the core thesis of this video. Gold is the vault. Silver is the cash register. Central banks hoard gold because it holds value. But when you need to actually move goods across borders, settle trade invoices, pay suppliers, handle daily transaction volume, you need a metal with liquidity. Gold is too valuable, too thinly traded, too illiquid for day-to-day settlement. Silver is consumed in industrial production every single day. It moves constantly. It's cheaper per unit, easier to fractionally divide, and it's already embedded in the supply chains of the exact industries, solar, EVs, electronics, that BRICS nations are building out aggressively. Silver isn't just a precious metal in this context. It's the transaction layer of the new multipolar economy. Here's a question I want you to sit with for a second. If BRICS nations represent over 40% of global GDP, and they're building trade infrastructure that doesn't need the dollar, what happens to assets priced in dollars that are scarce in Asia? We're going to answer that directly in the next section. Don't go anywhere. The regulatory wildcard, how US bank rules are accidentally supercharging silver. Now here's a story that broke just this week, and almost nobody in the silver community is connecting it to what we just discussed. Reuters reported that the Trump administration is quietly overhauling Federal Reserve oversight of Wall Street banks. Treasury Secretary Bessent, Fed Governor Bowman, and potentially incoming Fed Chair Kevin Warsh are pushing to loosen the post-2008 capital rules that big banks have operated under for over a decade. Specifically, on March 19, 2026, regulators proposed softened versions of what's called the Basel III Endgame rules, which would lower big bank capital requirements by roughly 4.8%. Because buried inside Basel III is a rule that changed how banks account for physical gold and silver on their balance sheets. Under the new framework, allocated physical precious metals are treated essentially like Tier 1 assets, the safest, most capital-efficient category, similar to cash or government bonds. Previously, banks were penalized for holding physical bullion. It cost them capital, so they held paper derivatives instead. Under the reformed rules, holding physical silver actually helps their capital ratios. Banks are now incentivized by regulation to accumulate real allocated metal. This isn't a retail trend. This isn't Reddit moving a market. This is Wall Street being structurally pushed toward physical silver ownership by the rulebook they operate under. The full impact of these rules plays out over 2026 and 2027, but markets price the future, and the direction is clear. The supply side, why this deficit is unlike anything we've seen. Let me layer one more piece onto this picture, because even without BRICS and Basel III, the fundamentals alone tell a compelling story. The silver market has been in a supply deficit for 6 consecutive years. That means the world consumes more silver every year than miners produce. In 2025, that deficit was estimated at around 150 to 200 million ounces. And unlike gold, where above-ground stocks are massive, silver gets consumed, it goes into solar panels, and it doesn't come back. It goes into circuit boards and electronics, and it's gone. Now add China's export restrictions, effective January 1st, 2026, which limit how much silver China can send abroad. China is both the world's largest silver producer and the world's largest consumer. When they restrict exports, they're essentially weaponizing the supply chain. And now stack on top of that COMEX vault outflows, SHFE inventory at decade lows, Basel III bank demand, and BRICS strategic stockpiling. You are looking at demand shocks hitting from 5 different directions simultaneously: investment, industrial, regulatory, geopolitical, and monetary. That is not a normal market setup. The price scenarios, what could actually happen next? Okay, let's talk numbers. And I want to be clear. Nobody knows exactly where silver goes from here. Anyone who gives you a precise price target with certainty is selling something. What I can do is walk you through the scenarios. Scenario 1, base case, $80 to $100 by mid-2026. This is the most likely path if the current range holds and fundamentals continue. Silver finds a floor around $66 to $67, consolidates through April, and then breaks upward as Basel III bank demand kicks in and BRICS trade infrastructure expands. The SHFE premiums eventually pull Western prices higher. Classic convergence trade. Scenario 2, bull case, $120 to $150 if the petrodollar fracture accelerates. If Saudi Arabia expands yuan oil deals, if BRICS formally adopts a settlement mechanism involving silver, or if U.S. inflation data forces the Fed to cut rates aggressively, you could see a second leg up that eclipses January's highs. This is the scenario where silver's monetary re-rating happens faster than expected. Scenario 3, bear case, back to $55 to $60 as macro turns hard. If the US dollar surges, driven by a risk-off event, a geopolitical de-escalation that kills safe haven demand, or a Warsh-led Fed pivot that spooks markets, silver could see another leg down before finding a real floor. The paper market can suppress prices for longer than fundamentals suggest it should. Right now, we're in the chop phase between Scenario 1 and Scenario 3. The fundamentals favor the upside. The technical picture says be patient. The key levels to watch: $74 to 75 cents. If silver closes above this with strong volume, Scenario 1 is in play. 64 to 65. If this breaks on a weekly close, Scenario 3 risk rises significantly. The SHFE premium. If it narrows below $10, demand may be cooling. If it widens above $30, accumulation is accelerating. So let me bring this full circle. The crash from $120 to $67 wasn't the end of the silver story. It may have been the setup. Shanghai is paying premiums Western exchanges can't explain away. Banks are being legally incentivized to hold physical metal. The petrodollar system, the financial architecture that's governed global trade since before most of us were born, is slowly, quietly being rebuilt around new foundations. And silver, the metal that moves goods and powers green technology, sits at the intersection of every single one of those shifts. This is not a get-rich-quick trade. The chop zone can last weeks or months. Patient positioning beats panic. But if you're the kind of investor or trader who wants to understand what's actually happening beneath the headlines, this is the story to follow. Here's what I want you to do right now. Drop in the comments, which scenario do you think plays out? $80, $150, or back to $55? Subscribe and hit the bell. I cover COMEX positioning, COT reports, and the SHFE Premium weekly. Check the description. I've linked the live premium tracker and the COT data dashboard so you can monitor these levels yourself. The next video in this series is going to go deep on India's role in the silver supply shock, and the numbers there are just as surprising as what we covered today. I'll see you in that one.